Hello viewers, welcome to Knowledge Point. Today we are going to discuss about different finance related ratios and how they are useful to calculate different business situations in our daily routine. Let's move to ratios. First of all, we have liquidity ratios and it contains two different ratios. First is current ratio, and current ratio is equal to current assets divided by current liabilities, and it is used to measure ability to meet current debts and current assets. If current asset is equal to current liabilities, then the ratio is equal to 1.0. If the current liabilities are greater than current assets, that will be just enough to pay down the short-term obligations. Let's move to other ratio. Quick ratio. Quick ratio is equal to current assets minus current inventories plus prepaid and current liabilities. It is used to measure the ability to meet current debts and most liquid current assets. Now move to activity ratios. Activity ratio contains different ratios. First of all, we will discuss about debtors turnover ratio and is equal to credit sales over accounts receivables. It is used to indicate that which debt financing is used relative to credit sales and account receivables. Let's move to credit turnover ratio, and it is equal to credit sales over accounts payable. It is used to measure how number how average number of days for payables are outstanding. Inventory turnover ratio, and it is equal to cost of goods sold divided by inventory. It measures how many times the inventory has been turned over sold during this year. It produces insight into liquidity of inventory and overstock. Working capital ratio, and it is equal to sales divided by net working capital. It measures profitability with respect to sales generated profits and through net working capital. This ratio is very useful and many business uses this ratio in daily life. Expense ratio, and it is equal to earning before interest and taxes divided by interest expense. It indicates ability to cover interest charges. It also tells number of times interest is earned. Earning per share, and it is equal to earning after tax divided by number of shares. It indicates that what is the company earning per share throughout the year. Let's move to return on asset. Return divided by assets. It measures earning power of shareholders as compared to assets. Let's move to return on assets. Equity, return over assets. Measuring earning power of shareholder books value on investment. Let's move to profitability ratios. Probability ratio has first ratio, and which is called gross profit ratio, and it is equal to gross profit divided by sales and multiplied by 100. Gross profit is equal to net sales minus cost of goods sold. Net sales are equal to total gross sales less returns inwards and discount allowed. Net profit ratio. Net profit ratio is equal to net profit divided by sales. It is used, and a good margin will vary considerably by industry, but as a general rule of thumb, a 10% net profit margin is considered average, a 20% margin is considered high or good, and a 5% margin is low. Let's move to profit ratio. It is equal to operating ratio divided by sales. The operating profit margin ratio indicates how much profit a company makes after paying for a variable cost of production such as wages, raw materials, etc. It is also expressed as a percentage of sales and then shows the efficiency of a company controlling the costs and expenses associated with business operations. These are different ratios we have discussed. I hope this will help you in your different business routines. Thank you. Take care. Allah Hafiz.